And a good day to all you real estate professionals, potential home buyers, potential home sellers. This is Victor Bals with USA Mortgage and our friends over at Assist My Realtor. And today we're going to talk about the market, the 2023 mortgage and real estate forecast here. There's a lot of good information. If you can stay to the end, you're going to get a whole new insight to all this fake media and actually where we're going. So I am going to share a screen with you, and here we go here. And so let's get rolling here. So before we get to the 2023 forecast, let's go back and see how we got where we're at. Everybody remembers the mortgage crash of, the Great Recession of 2006 to 2009, but what happened back then and what lessons have we learned and what psychological aspect does this have on the average first-time home buyer of today? The average first-time home buyer is about 33 years old. So back in 2006, 2009, they were 17, 18 years old. They were in high school, and their parents actually had to go through this recession. And a lot of the lessons they learned from then are now passing on to their children. And we're seeing some uncertainty in the market there. And we're seeing a lot of hibernating buyers that, the market's going to crash and burn. We're in another bubble. Rates are too high. Wait for rates to come down. Let's kind of go ahead and look at there. So this information is brought to you by MBS Highway, Barry Habib. I've followed this guy for 20 years, and also myself, I put some stuff together. So let's go back here. So when we look at the past housing market, first of all, in 2001, there was the dot-com bubble. This is when the internet started back in 1995 through 2000. Internet was going crazy. Yahoo, Google wasn't even around at that time. And anyway, there was slow internet, dial-up internet, computers were slow, and everybody invested in that. And then we had a dot-com bubble burst, right? All those dot-com companies went out of business, or a lot of them, and hundreds of thousands of jobs were affected. And also in that year, later in that year, the 9/11, that was the attack of the World Trade Center, and the economy kind of went into a tailspin. Over the next few years, the government spent a lot of time and a lot of focus on, national security, which, of course, we all understand that. So in 2004, the economy was still in a recovery from those recent events. Okay. In 2004, the feds lower interest rates to kind of stimulate the economy. They want to get some home purchases going there. And they're trying to do something because everybody was still scared and the economy was still doing bad. So in 2004, the government wants to increase home ownership. In 2004, the banking institutions create what they called subprime mortgages. And in some of those subprime mortgages, if any of you remember, these were called 228, 327 arms and option arms. Now, these, for example, a 228 arm, it would stay fixed for the first 2 years, and then it would adjust after the second year. And these adjustments could be 2%, 3%, 4%, 5%. They could go up. Now, and these were also, because of their subprime, these were stated income loans, 580 credit score, no income, no assets, a self-employed person, maybe they're cutting grass and they state that they're making $400,000 a year. Well, sure, here's a $400,000 loan, 100% financing. Okay. And basically, if you could fog a mirror, you could get a loan. And these were very high risk loans. Now, how do mortgage-backed securities actually work? Okay, so I want you to understand what happens in the lending world. So let's say I, the lender, grant you a loan for $100. Okay, once we close in that loan, we sell your loan to the secondary market for about $103 because they're going to buy that loan from us for $103, and because we have to pay our loan officers, our workers, pay the rent and all that. So we sell it at a bit of a profit. Now, the secondary market now divides that loan, that $100 loan, not into 10 shares at $10, but 11 shares at $10. So they gross $110. Okay, the secondary market now, after paying us 103, they sold it for 110. They net $107, so they make $7 on that loan, and they also retain the servicing rights, where they can make the payments, pay the escrows, call you when you're late on your payment, answer questions and all that. But there's a value in that loan. So now, these shares that they sold on the secondary market, these are actually broken up into stocks, mutual funds. These are actually part of your retirement. And when you look in your retirement portfolio, you're going to see that part of that is in real estate, a very, very safe investment. Okay. And these investments in real estate were always labeled, or they were rated at a triple A investment, not a triple B, a triple C, or junk. They were rated triple A. So they're very good stuff. And these subprime mortgages that were rated mistakenly triple A, regardless of risk, got stuck in your retirement portfolios. And now, due to an algorithm, when they sold these and they rated these, they measured everything. This algorithm calculated everything at a 6% appreciation rate, never even considering values would go down, because values were just shooting up at that time. And it's just the way the things were. So they mistakenly rated these things. Okay. And the subprime loans were treated the same as an 800 credit, 20% down. Okay. Sold in the form of treasuries, treasury bills on a global scale, mortgage-backed securities. Okay, it's a security, it's an instrument, it's like a saving account. That's an instrument, but it's backed by a mortgage. So now, for example, if a credit card, you default on a credit card, the credit card companies come after you, there's nothing that they could take back. However, if they foreclose on a home, they are able to go sell that home and recoup some of that cost. Now, in 2006, the economy takes a turn, inflation begins to climb. And those subprime mortgages, they start to adjust. Remember, they stayed fixed for 2 years, and they start to adjust. And now these interest rates started to go up 2% up to 5% in some cases. Builders started receiving spec money for new construction. Back in the day, a builder can go into the bank and say, hey, I want to build some homes. I need some spec money. These were sold as spec homes. So the banking institutions, they'd give them, hey, here's $1 million, here's 10 million, here's 20 million, go build a home. And the builder said, well, you know what? I may build some homes, but I'm going to go build condo complexes, because I can split those very quickly and just build multiple homes. Now, the interest rates started to climb. And now builders started to slow down, because as these interest rates started to climb, it stopped spending. People didn't want to buy homes. And so now these builders were forced to start laying off some people, and they started having this inventory. Americans started tightening their belt. They started cutting their own lawn. They say, hey, money's a little tight there. I'm not going to farm this out. I'm going to start cutting my own lawn because I'm going to start cutting back. Now, the stated income, no asset loans, and the ARM and the option arms, they all start to default. Okay. And what was happening is these loans also had prepayment penalties of 3% the first year, 2% the second year, and 1% the third year in a lot of the cases there. So on a $300,000 loan, if they wanted to refinance within that first 2 years, because interest rates were going up, not only did they have to refinance, they would have to pay a prepayment penalty on a $300,000 loan. That would be $9,000. However, if values are they're starting to decline, values are going down here, their house is not as worth, they owe more on the house than what it's worth. And this all started to snowball. Okay. So now, with a surplus in housing, home values, they start to plummet. And foreclosures begin, and values start dropping so much there. And then all of a sudden, the short sales start happening, because they're owing more than what the home is worth. Mortgages are not performing now take effect on American stock and mutual funds. Remember, all these subprime mortgages were stuck in rated AAA, all into those mutual fund investments there that were supposed to be very safe. And now we start to see a drop in home values about 40%, and the stock market starts to drop, and it just throws America into a tailspin. And also the USA, they tarnish their reputation for the treasuries, these mutual funds and all that are supposed to perform very well. Stocks start falling in price, and around the world, they all invested in US treasuries because they were so safe. So it kind of busted our reputation there. And due to the AAA rating of these high-risk subprime loans, 2008 came, and that was the bailout. That was the Emergency Economic Stabilization Act of 2008. And if any of you remember, we were going broke. All the auto industries were going broke. They had to bail out General Motors for billions and billions of dollars. And a lot of Americans didn't want to bail out the automotive companies at that time. So now in 2010, the CFPB, Fannie Mae and Freddie Mac, they need to rewrite the mortgage guidelines because they say, man, how the hell did this happen? We can't let this happen again. And what they did is they revamped loan officer compensation, like myself. Okay, because back in the day with a mortgage compensation, here's the thing. Let's say I had a distressful situation in my home life. I had a bankruptcy, a foreclosure, a divorce, something like that. I had a negative impact, and it could have made me desperate. So now when a consumer comes in, I would be able to, I guess, steer them into the one type of loan versus another, because I can make more money off another type of loan. And so we had to wipe all that out. So the Fannie and Freddie, they rewrote these guidelines, and they said, look, loan officers are going to get paid the same on every loan, regardless of anything, because we don't want the loan officer to steer. We want them to look out for the best interest of the customer. So now also, they are now required a credit check, a background check, fingerprints, and fidelity bond insurance on loan officers there. In 2007, there was approximately 17,000 loan officers in the state of Michigan. And by 2010, there was only about 2,500. And thank God I was still standing, because I kept my nose clean there. So that was pretty good. And then in 2010 to 2019, the economy started to recover. Values started going back up. The economy stabilizes. So now in December 19, we hear something called COVID-19. Right? Something came from China, and there was some whispering, and of course, COVID-19 came. In March 2020, the United States shuts down. Everybody's wearing face masks there. And then in March 16th, 2020, in Michigan, Governor Gretchen shuts down Michigan, shuts down real estate. You can't even show homes. Okay, so let's move forward a little bit here. Okay, so that was the past, and that's what set up the psychology for all these first-time home buyers coming on the market now. Their parents lived through this whole situation, and they may have the jitters. The market's going to crash. Interest rates are going up too quick, too fast. There's going to be a bubble. We're going to be like 2009 again. I don't think so, and I want to show you why here. So on this chart right here, remember, in interest rates, mortgage interest rates always follow inflation here. So now if you look at the blue line right here, these are mortgage interest rates from 2018 right to 2022. And I want you to take a look at inflation. We were chucking along here right around 2% inflation. And if you notice here, every time that inflation goes up, rates go up a little bit. Inflation comes down a little bit, mortgage rates come down here. And then here during the pandemic here, inflation actually took a real dive, and we got down to near 1%. Okay, and look at the interest rates. Interest rates follow it. But at this time, the feds came in because, remember, we were in the pandemic. There was supply and demand. Everything was shut down. So the government says, hey, how do we stimulate this here? So what they did in this white area here, this is called the QE period. This is quantitative easing. Excuse me. So the government came in and they started buying all these mortgage-backed securities from the lenders. They just kept buying all they could, $70, $80 billion a month. And what they did is actually kept interest rates very low. And if you guys remember, in 2020, interest rates actually went down to a 2.65% on a 30-year fixed. But what happened during then, because of the pandemic, inflation started to go up here. And this was the supply chain. You remember trying to get a refrigerator, trying to get furniture, trying to anything. It would just, everything was backlog. It was going to take you forever. So the price of everything, because the demand went up so much, prices started to go up, and inflation really started to skyrocket here. But mortgage interest rates right here continued to stay low because the government was in there buying these mortgage-backed securities with this quantitative easing, kind of falsely keeping those interest rates tied to that 3%. But after the government, they said, well, wait a minute, inflation is getting out of hand because they're buying all these mortgage-backed securities at 3%, but yet inflation is starting to go up to 6 and 7%. So think of you as an investment. If you're getting 3% on your investment, but yet you're going out to try to buy goods and pay your employees, and it's at 6%, you're actually losing money. So the government stopped buying mortgage-backed securities right here. And what do interest rates do? They always follow inflation, and they started to climb. At the beginning of 2022, we were down at 3%, 3.25%. But at the end of 22, we actually hit about 7 3/8% on the mortgage rates there. But you can see here, as the inflation goes up, mortgage rates follow. As inflation comes down, mortgage rates started to tip down a little bit. As inflation goes up, mortgage rates go up. And here, right at the end of 22, inflation goes down a little bit, and so do mortgage rates. So now, let's show you why. Now, this chart is a little interesting. Don't get overwhelmed. I'm going to explain it. And if you can understand this, you're going to understand the reason behind this. When will inflation peak? This is the consumer price index, or it measures inflation. And currently, it's 5.7% year over year. So how does inflation work? You've got some numbers here in yellow, and you've got some numbers here in white. But when we look right here in December, and this is monthly, so back in October 21, that inflation rate for that month was up 0.6%. In November, it was up 0.5%. In December of 21, it was up 0.6%. Now we come here to 2022. Here's December of 22. Now this report just came out in January, okay? And what happens is this number here, because if you add up this number, these last 12 months, remember it's year over year, 0.5, 0.3, 0.6, 0.6, 0.7, this adds up to 5.7. That's how they get the inflation for the year. So it's kind of a slow riding thing because it's measured month over month, year over year. So when the number came out in December of 0.3, it replaces last year's number of 0.6. So that's a 0.3 reduction. So we were last month at 6% inflation. But now that this number replaces last December, we come down to 5.7. And when inflation starts to fall, we are going to see mortgage rates follow. So now as we look into January, and these numbers will come out next month, and now remember, the feds are raising the prime rate, 25 basis points, 50 basis points, 75 basis points. What does that mean? That actually means 0.25%, 0.5%, 0.75%. But this is on the prime rate. This isn't mortgage rates, right? That's short-term lending. This is money on home equity lines, credit cards, and automobile loans, short-term lending. And what the government wants to do is raise that prime rate to have you, the consumer, stop spending so much. And by raising those credit card interest rates, that's going to slow you down from out there spending, which means you're not going to buy so much, which means the supply chain will fill up and we'll have a surplus. If we have a surplus, that means demand is down. And what do? They will lower prices. And if they lower prices, that will lower inflation. If inflation comes down, what follows inflation? Mortgage interest rates. So as we look into the spring of 2023 here, we're going to see this number is going to get replaced in February. That should be a lower number. But here, look here in April, May, and June. These are very high numbers. And with us raising the prime rate and everything they're doing in the economy here, these numbers should be replaced by much lower numbers. Okay, so I think in April, May, June, July, and August, we're going to have some significant decline in inflation. If we do that, mortgage rates are going to follow. And here's the magic dates. February 14th, March 14th, April 12th, and May 10th. These are when these CPI index numbers come out, which we should see inflation fall pretty good. So now here's the next thing. This is the shelter cost. Okay, shelter cost means this is for new leases. Rents have went up, and of course home prices and mortgage rates have went up. Shelter costs went up near 18% in 2022. You know, to get a new rental on an apartment, to buy a home, you know, these interest rates are up there, and now they started to fall. Here's the real time. Right now they're increasing only at 4.6%. But what happens now, this shelter cost here, this is actually 39% of that CPI index. So shelter plays a very key role in that inflation, measuring inflation. It's coming in at 39% of the entire inflation report. And so when we have these high numbers, it makes that inflation go up very high. But this report is measured year over year. And so when you see the blue line, when we take shelter cost, although they're still climbing, this takes a 1-year average from here, and here's our real cost. Right now, in January of 2023, shelter costs are still increasing, but they're only increasing at about a 4.6%, not 18%. And so when we go over year and we average that, we're going at about 7.9%, and it still tends to be going up. Okay, so now what I want you to think of here is, imagine yourself on a roller coaster, and these are shelter costs. And when you're on a roller coaster, you're at some point when you're at the top of the hill where part of that roller coaster is coming down, okay, and part of that roller coaster is coming up. And that's how you can actually look at the shelter. When we look at that past graph there, we still see shelter going up at that 7.9%, but we know the real shelter costs are only 4.6%. That's starting to come down. So as we get through January, these shelter costs are going to peak out and start falling, because remember, those lease payments and that they signed last year, those are lagging because they don't come due to this year. So when they re-sign their lease, that lease costs will go down, and that's going to show shelter costs. As these people had higher interest rates, as interest rates fall, they are going to refinance, thus making shelter costs less. So it's kind of a lag effect. So on shelter, you know, prices have come down across the board for food, gas, clothing, etc. And all these are reflected in the consumer price index. But the shelter cost, which is 39% of that CPI, although it's coming down the hill, are still showing increases due to that lag effect. That back end of that roller coaster is not at the top of the hill because of these leases are not resetting and prices going down there, which they will. Now, here is the 30-year mortgage rates versus the 10-year Treasury spread. Okay, and the 10-year Treasury is a Treasury that you can go out and buy there. And historically, over 35 years here, the normal spread is 175 to 200 basis points. That means 1.75% to 200 to 2% here. And notoriously, those mortgage interest rates are usually about 2% higher, about 2% higher, about 2% higher. But here in 22, because interest rates went up so high, so quickly, what we're seeing is almost a 3% gap in the mortgage rates versus the 10-year Treasury. Now, in 2022, this is one of the first years in my 20-year plus of doing mortgages where we had to charge discount points, the cost for getting a loan. And now remember, the smart money, all these investors out there, they can read these charts. They know rates are going to come down. They know the tools that we're using with the government are going to lower inflation. So what's going to happen is they know as soon as these rates drop, people are going to refinance. And remember, a lender, an investor, a servicer, they want to service those loans for 2, 3, 4, 5, 6 years, because remember, they sold those stocks and they received the servicing rights. And so they know that if rates come down, they're not going to have these loans for years. They're going to have them for months. And so they're charging extra cost up front because there's no value in these loans for the long-term servicing. And as we go right now, we are starting to see not a 300-point or a 3% gap. It's starting to narrow to about 250 or 2.5%. So we're seeing that gap narrow as inflation comes down, as shelter costs start to come down. So very interesting. And this is a 35-year record, so it's a pretty good indicator here. As we move forward here, is there a recession coming? Let's take a look at this. This is pre-pandemic right here, and these gray bars represent they represent recessions. Okay, credit card use was going up here until the recession, and nobody could go out shopping, so credit card use went down there. But now, as we started to pull out of the recession and the country starts getting back going, look at that credit card use right there. We are at a peak. We are way up above pre-pandemic levels. Now, a recent report says, credit card use, 50% of Americans can't pay off their monthly credit card balance. The average credit card balance right now in America is about $5,500. And with the increase in the prime rate, that is raising the interest rates on credit cards. It's near 20%. If one was to make the minimum payment on that $5,500 balance at that interest rate, it would almost take them 17 years to pay off that credit card balance. Let's look at savings. Pre-pandemic, savings was whirling around here. The pandemic came in, and boom, here comes the savings. And if you look at this peak right here, this peak right here, and this peak right here, this was the federal stimulus package. So we got some money here, got some money, and all of a sudden, savings started to dwindle. Credit card use is going up through the roof here. And this just tells you the resilience of Americans. They do not want to give up the lifestyle. And that's why we're seeing so many jobs in the service and travel. I'm still going on that vacation. I'm still going out to eat. But at some point, this credit card use and the dwindling savings is going to hit a brick wall. Okay, and stopping that spending out there, what does that do? That raises our inventory, our surplus. And if there's too much surplus, prices come down. As demand comes down, and if prices come down, inflation comes down. And if inflation comes down, mortgage rates will follow. Okay. Let's look at the inverted yield curve. This is a pretty good indicator of a recession. And this here is a 30-year history here. Now, you go out and you buy something on a 10-year treasury note. You can go buy those. And today you could make 3.5% or so on them, about 3.5%. But look at this. On a 2-year treasury, you can actually make 4.25%. Now, why would you make more money on a shorter term investment? If you're going to go out and buy a long-term investment, shouldn't you get rewarded more? That's always been the case. But when we hit an inverted curve where you make more on a short-term investment than a long-term investment, let's look at the history. Back in 1985, it almost inverts. We hit a recession. 1989, that inverts where you're making more on a short term than a long term. We hit a recession. It inverts. We hit a recession. It inverts. We hit a recession. Right near the pandemic, it inverts. We hit a recession. Now, look where we're at right now. That's a pretty good indicator that if we are not looming in a recession, if we're not one already, one is coming, okay, based off of history. So let's take a look at this. Housing demand. Okay, this is household formations. Now, this isn't new home buyers coming on the market or new births or nothing like that. This is just household formations, meaning that a household of 4, household of 5, that someone comes of age and they decide to go out and rent or go buy a home. That is considered a household formation. So back in 22, we were clipping along around 1.75 million. Okay. And then what happened? It dropped in March, April of 2022 because rates started to really climb right at this point because the government stopped that quantitative easing and buying those mortgage-backed securities. And as soon as they stopped buying them, interest rates skyrocketed. Okay. So the general consumer says we're going to stop buying here. But then it went up in this May timeframe because school's going to be getting out and all that. These were the people that had to make a move here and get through the summer. And look, so right there in about August, soon as school starts, boom, everything crashes down there because those are the people that had to make a move. Everybody else started to say, we're going to hibernate. And right now we're clipping along about 1.3 million household formations. Now, very interesting, because when we look at the new housing supply, Housing start completed. This means new constructions. We're on average of about 1.5 million a year. However, about 100,000 of those homes are actually torn down, okay, because they're old, dilapidated, and all that. So they just tear them down. So our total new supply is only about 1.4 million, and we're clipping along at about 1.3 million household formations. So we actually have we're building somewhat of an inventory, and that's why we've seen the recent decrease in home prices. And builders are very cautious about building homes because they've learned their lesson from 2009. You know, home price moderation. Are we going into a crash? Many people say, we're going to bust, we're going to bust. Hardly the case here. When we look at home prices for the past 10 years, we're up 115%. And right after the pandemic in the last couple of years, we're still up 39%. And here right now, we're starting to see that dip in home prices of just 2.5%, but they are trending upward. But that's because of the hibernating people there, just waiting for rates, waiting for something to happen. As we move on in the state of Michigan, you know, every new home build affects the economy about $72,000. This is 17% of the gross state product in 2020. And on a new construction, you know, just the permits, the excavating, and all that creates about $36,000 in revenue. For the real estate professionals, the appraisers, title companies, loan officers, about $19,000 in generated income. And then we got furniture and appliances and painters and all that. And we actually got the guy that cuts down the trees to make the pulp for the boxes for the moving companies. So it's a very big industry, and it's very important to our economic security here. So now, as we're moving along, you know, we could have almost predicted 2009 crash here. Now, this is births under each generation here. Baby boomers, Generation X, millennials, and post-millennials here. Now, we know the average home buyer is 33 years old, but look at the population decline right here. And why is that? If you look right here at 1960, you know what happened in 1960? The birth control pill was legalized. And at that point, we started to see the birth rate go down, 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 down. And now, if you were born in 1973 and you were 33 years old, that average first-time home buyer, that takes you into 2006, right when the Great Recession came. Let's take a look at that. So in 2006, remember we talked about those builders here in orange doing all those new builds, but yet our population in blue kept crashing. So we had way too much surplus. We had all the subprime loans that were defaulting, creating more surplus. With more surplus, you know, prices go down, values go down, and that's what started the whole crash. Let's go back here for a little bit. Now, our average first-time home buyer today, in 2023, you were born in 1990. And as you see, birth rates continue. We're right here. So we're going to see a little bit of decline in birth rate, but it's going to go up. So we're going to have 10, 15 years of some very good household formations. Okay, affordability, Livingston County, Michigan. 1998, the median income, household income was $5,500 or $4,583 a month. In 1998, I bought my first home here, and it was a new construction. It was $138,000, and my interest rate was 7.375. And I'll always remember that payment: $1,234 for pity, principal, interest, taxes, insurance. That was 26% of the household median income. And with debt to income ratios, if your housing expense is under 29%, very affordable according to Fannie Mae and Freddie Mac. That is just kind of the norm. You're a gold star player here. So now let's fast forward to 2023. The median income household in Livingston County is approaching $90,000 or $7,500 a month. Now, in 2023, that same house is going for about $275,000. Rates are at about 6.5%. and the median income, it's costing us 27%. So almost as affordable as it was back in 1998. And as we predict rates to start falling here in 2023, that $275,000 loan, we expect rates to hit down in the low fives. That principal and interest payment based off the median income would only be 25%, making 2023 actually more affordable than 1998. So what is our housing forecast for 2023? We're going to see some lower inflation. We're going to see a recession-like slowdown, which we're already seeing here. Incomes are increasing to help affordability. We're going to become a very tight inventory environment once again as these household formations come out of the woodwork. They come out of mom's basement because rates are low and they want to take advantage of this. And rents are still expensive, and they're gonna still rise at about a 4.5% clip, but not an 18% clip that we've seen last year. We should see low single-digit appreciation, maybe 3.5%, 4% for most of the United States, with a pickup in, of course, purchase activity here. And our mortgage rate forecast, our headwinds, we got global quantitative tightening, not global quantitative easing where the government's stepping in and buying all these mortgage-backed securities. Us and globally, they're stopping to do that. The banks are not reinvesting in these mortgage-backed securities. And we got more debt to be financed. We've seen that credit card debt. We've seen the prices of stuff. And so there's a lot of debt out there. Those are the headwinds. But the tailwinds are, we've got lower inflation that's going to lower cost. We've got excess retail inventory. We got plenty of surplus. There are no surplus shortages anymore, which is going to drive prices down. We got an increase in mortgage service value. So the investors are not going to be charging these discount points or these additional charges to get mortgages because they know rates are coming down. When they get a mortgage, those people are going to hold those mortgages for 2, 3, 5, 6 years and give a great value for those investors here. A recession is likely if we're not in it already. And every time we're in a recession, we get appreciation, but rates will come down. So with that said, we expect the 30-year fixed rate mortgages to be down near 5% during the first half of 2023, and the U.S. Treasury bill to be Treasury note to be at 3% or lower. And anyway, it's been a pleasure. If you want to join our Facebook group there's the QR code and all that stuff. And if you got any questions or concerns, and please share this video with your friends, your family, anybody who's thinking about the house. I hope we brought you some value there. Leave some questions, some comments on what you think there. And you can always get a hold of me at 734-417-2115. I am Victor Bals, and it's been an absolute pleasure here, and I eat this stuff for breakfast. So just wanted to say thank you very much and have a prosperous year here. Call us with any questions, but I think we got some very good years coming for the real estate and the mortgage industry. Let's do it. Thank you.